Hello everyone and welcome to this week's video on the Momentum Lab channel. As you have known that in the last few videos, we have done focused videos on factor investing. So we have taken strategy and then we have looked at several factors such as momentum, low volatility, quality, etc. So we have had a lot of questions in our comments, and thanks to all of our followers who bring up these interesting questions about, how a Nifty mid cap, a particular market cap is performing, or, how a particular thematic is performing like infra, and how, let's just say another sector is performing, etc. So what we thought was we will stack all of these different categories of indices together. And then we wanted to zoom out into all of these categories and see how all of the indices within these categories perform. So if I look at just equity investing, we have four broad styles or categories of indices that exist with us. First one is the broad market. Like the name suggests, broad market is based on just the market caps. So there is Nifty 50, there is Nifty 100, next 50, there is Nifty 500, and total market cap, which is the Nifty 750, etc. So the broad market category largely covers only based on the market caps of the available, the market caps that are available in Nifty. Now coming to sectoral category, sectoral category focuses on a very particular sector. So there are several sectors available to us in the equity markets. There is auto, banking, there's pharma, health, so on and so forth. And each of these particular index, it focuses on a particular sector. So if investors want more exposure on a particular sector, sectoral index investing is the way to go. Another kind of category that we have is thematic. Now, what thematic and sectoral look very similar, but thematic is nothing but it's a cross-cutting among different sectors. So, like if you talk about infra, then several sectors such as sports may come in, telecom may come in, etc. Right? So thematic largely covers different sectors that come under one particular thematic of an understanding. Now, as you know, the last and other category is strategy, and we have been discussing strategy in detail. And the strategy category largely focuses on developing indices with respect to one factor or multi-factors. Now, the large idea of strategy investing is that, you generate excess returns. The focus is always on getting excess returns. So the focus is on generating alpha. Now, given all of these categories that exist or styles of indices that exist, what we are trying to do is we have tried to put in all of the indices that are available based on different styles or categories. And we have brought in detailed, we have brought in detailed returns, such as, the 1 year median rolling return. We have 3 years rolling returns. We have 5 years, 7 years. And we also have volatility and drawdown captured over here. So what we're essentially trying to do is that the first four indicators that you look at, which are capturing the rolling returns, they together focus on how all of these indices are performing, or how are the returns for these indices. And risk is another important category when we have to consider, where we have to invest or how the performance is like. So what we have done is we have used volatility and maximum drawdown to capture the concept of risk. So in the earlier video, if you remember, we had taken several other concepts such as, the bottom 25 percentile. We have also looked at the top 25 percentile, etc. So what we can do, I think, Shekhar, is that we can deep dive into all of that in a next video. But for now, and for the point of view of this video, we will be limiting only to risk and returns. Risk is captured by volatility and drawdown, and returns we are also looking at different time frames. So overall, we have considered 20 different indices in strategy. We have considered 15 different indices in the sectoral category, 11 in the broad market category, and 9 in thematic category. Now, I'd like to take you through what exactly the exercise was carried out and how exactly did we do it. If you look at this particular sheet, this covers every data or every data point that we have taken to arrive at the numbers that we are talking about in the previous chart. For example, this is a Nifty. This talks about, in the sectoral indices, it talks about Nifty FMCG. And here what we have done is we have collected the data of over 20 years. So the data spans from somewhere around 1st of August 2005 to 20th of August 2024. So over a period of around 20 years, we have collected the daily data, and we have calculated a daily change percentage, and that will resultantly give us an NAV. Now, we have a lot of data points in terms of the total returns, but if we have to make comparisons across the indices to find out, how their performance is, we need some kind of normalization. We've been doing this across in our different videos as well, and even when we track our portfolios. So NAV is that normalized value, and then when we calculate NAV, and then we also calculate the drawdown to understand how exactly what exactly is happening and going through in a particular index. Now, after calculating this, we have also calculated rolling returns for 4 different time periods: 1 year, 3 years, 5 years, and 7 years. Now, let me just show you how we've calculated it for the 1 year time period. What we do when we calculate rolling returns is we sort of see the returns hence from that particular period. So when I say 1 year rolling return, and the data is starting from 1st August 2005, my 1 year rolling return calculation will start from 1st August 2006. And this will happen similarly for 3 years, 5 years, and 7 years. In fact, to make it easy for people who are viewing this particular video, I will be linking this sheet as well, where you can sort of see what has been calculated, how, and now these data points are pretty robust. And if I have to take you through where these data points have been brought from, we have a particular data availability in the NSE itself. So for Nifty indices, there is Nifty indices report / historical data, which talks about and which throws up a lot of different data for us on different indices if we want to get the data and analyze it. So what we will be simply doing is that over here we will go to the total returns, and then you can select the kind of category you're looking for. You can be looking at multi-asset. You can also look at fixed income. What we want exactly over here is for equity. Now, after selecting equity, you can choose anything. Like, for example, let me just take a broad market index where, Nifty 100 it's first. So I'm selecting that. And then you also have the choice to select a time period. Once you are done and you just give a submit, you will be getting a lot of data points over here, which you can download and then import it into another Google Sheet, from which point you can make a lot of calculations. Now, after having calculated this, what we have done is that we have put all of those values together over here, and this is the larger sheet which talks about the returns and the volatility and risk, etc., for each of the strategy. But the interesting thing again over here is that, whichever time period you take, for example, I'm now focusing on the median 1 year rolling returns. You can see that the top performers are always strategy. And if you also zoom into what kind of strategy is performing or what kind of factor is performing, you will see that momentum and momentum quality together are the top performers. If you see the first 4, you have 2 pure momentum factors, and then you have momentum and quality are 2 more. In fact, consumer durables as a sectoral is coming as one index, but after that you'll also see again that the momentum, alpha, low volatility. So everything with relation to strategy is coming up. Now let's see what happens if we look at a median 3-year rolling period. And not with much surprise that Nifty momentum again is mid-cap 150 momentum 50 is again thrown up here. Again, the second one is momentum quality. So these 2 factors are sort of throwing up again for the 3-year rolling return period. Now I'll take you through the 5-year rolling return period and see. And again, strategy is coming up. And even within strategy, you will see that momentum quality has always held its top space. Of course, over here, when we look at a larger time period of 5 years, we also have alpha taking a small role. But largely, strategy is topping, and in strategy, momentum and momentum quality are topping. Now, if you look at the 7-year rolling period again, we again have strategy coming up, and in strategy, we again have momentum and momentum quality coming up. Now, let's also look at volatility because, so far it is just the risk indicator. And if you look at volatility, let's see what happens. Again, I think, the category that is throwing up is strategy. But however, when we talk about volatility, there are different factors that are coming up. Naturally, the ones that we expect, like quality, low volatility, alpha quality, low volatility. So largely, when we look at volatility, obviously the indices that are focusing on low volatility are coming up, and then the indices that are focusing on quality are coming up. But even over here, if you consider the risk and volatility showing the risk, strategy as a category of indices is coming up very, very profoundly. Now, we can also look at maximum drawdown as to, which sort of index has a maximum drawdown. And even in that scenario, I think while sectoral has some representation, largely the top 10, you will see that strategy is occupying the space with value, quality. It has low volatility. Again, multi-factor where alpha, quality, and low volatility are throwing up. So, Shekhar, I think, once again, when we zoom out a little more as well, we are seeing that strategy is coming up a lot more.
I think whichever lens we look at, be it the 1 year, 3 year, 5 year, 7 year, or volatility max drawdown strategies or factors are coming up. And within factors, we see if it is based on returns, we see momentum quality. And if it is based on risk factors, then we see more of quality and low vol coming up. Yeah.
Yeah, absolutely. So, of course, this table is a very detailed one, and it will be linked in the description for all of you to take a look at it. But if you just want to understand how all of these are spread up, how this risk and reward is spread across a canvas, I think we've drawn a scatter plot which sort of puts all of these data points at one place. So it's just for an easy understanding with this bubble chart. And this bubble chart focuses on a 7-year rolling return versus volatility. So on the x-axis, we have volatility, that is the risk that we'll be capturing. And on the y-axis, we have a 7-year rolling return period. So the maximum rolling return period over here has been considered. And even this has been generated using Python. So we will be sharing this code as well. If you're interested, you can reach out. And what you can do is you can play with different time periods. You can play with different sort of indicators that are available. And you will see how in a risk reward canvas, how are the different indices being performing. So in this particular canvas, let's just say we divide the canvas into 4 quadrants. We have 4 quadrants. The first quadrant is where the return is also low and the risk is also low. This is one quadrant. In the second quadrant, we have lower risk or lower volatility and high returns. This is a category which is pleasing to everyone because all of us want to have whatever less risk we can with high returns. Now in the third quadrant, what happens is it's a high risk, high reward sort of a quadrant, which again for some investors who have time, who have a risk appetite, is a good quadrant to be. Now the fourth quadrant, which is a high volatility, low return category, is absolutely a no-no for any sort of an investor, any investor with different kinds of risk appetite. This quadrant is not somewhere we want to be. Before I go into, let me tell you what are the representations. This green is representing strategies. The red is representing broad market indices. Purple over here is it's showing us the thematics, and blue over here is indicating the sectoral sort of the indices. Now, in all of this bubble chart, what we can see is the strategy again is falling into the second category or the most favorable category where the risk is low and the returns are high. And if you look at the red or broad market category, they're all bunched together in the middle. And if you look at sectoral, I think sectoral is what it's showing is it's spread across different quadrants. It's there in the fourth, it's there in the second, it's there in the first, it's also there in the second. So sectoral indices are spread across this canvas. And then when we come to thematics are somewhere concentrated on the lower part of the canvas. But by and large, what we can see is that the strategies that we have been talking about are in the low volatility, high return second quadrant over here, with Nifty mid 150, momentum 50 being sort of the highest in terms of returns. Now, Shekhar, I think there was also an interest about from our viewers about how these broad market category indices are performing and what we can make of them. So, can you please take us through that particular aspect?